further ado, let's start. It's 11 o'clock.
Please.
And we have a decent set of participants. So
Sure.
let's
So people will join in over a period of couple of next minutes. But I think it's time. It's prudent that we start on time. Thank you, Bhavesh. Dear friends, as Shailesh Bhai said, it's a beautiful morning in Mumbai. Warm welcome to all of you from MK Wealth. This is the fourth edition of budget event of MK Wealth called Budget and Beyond 2022. The objective of this event is simple: to understand the budget better with the help of experts who can dissect the budget and decipher its implications for the Indian economy. Our investment portfolios, our personal finance calculation, and its implication. Let me welcome all of you to Budget and Beyond and quickly introduce you the panelists of the day. We have a very distinguished and special panelist with us today. Of course, he was a part of Budget and Beyond in the last two editions too. His first audit was of McDonald's in Chicago, and he went on to be the chairman of many large companies in India. Chartered accountant and cost accountant, an internal auditor, and a certified financial planner and fraud examiner. The board chairman, audit committee chair, and independent director at some of the country's most prominent organizations. He is a well-known thought leader on Indian economy and public policy. He has authored two books, The Digital Professional and Audit Renaissance. Mr. Shailesh Haribhakti. Sir, it's a great
to
welcome you, sir.
Thank you,
so much.
Parag. Thank you.
Let me extend a warm welcome to Ms. Rajni Thakur, the Chief Economist of RBL Bank. She holds a master's degree in economics and Delhi School of Economics and MSc in finance from London Business School. She is a research professional with 15 years of rich and varied research experience across policy, consulting, and banking domain, and has covered global markets such as India, South Asia, Middle East in her previous roles. She heads research at RBL Bank. She was earlier macro strategist at Deutsche Bank. I welcome Ms. Rajni for this forum and panel today. Thank you so much for being here.
Pleasure.
Next up, we have Mr. Shridat Bhandwalkar. He is head of equities at Can Rebeco Asset Management Company. Rebeco's joint venture in India, one of leading AMCs, and have proven merit and established leadership in managing equity fund. He manages Canara Rebeco Equity Diversified Fund, Can Rebeco Blue Chip Equity Fund, Can Rebeco Infrastructure Fund, Can Rebeco Consumer Trends Fund, Can Rebeco Small Cap Fund, to name few prominent funds. He was earlier with SBI Pension Fund Private Limited and Motilal Oswal and MF Global CV Securities as well. Sridatta has done his BE and MMS in finance from University of Mumbai. Let me welcome this highly admired portfolio fund manager who heads equity fund management at Can Rebeco to the panel. I'm pleased to say that Sridatta too was with us in the last edition of the Budget and Beyond. Welcome to you, Sridatta. Thank you so much for being here.
Good morning. Hi everyone, and thanks Parag for having us again.
Thank you. We have with us on panel Mr. Devang Shah, co-head fixed income of Axis Mutual Fund. He is a BCom from Mumbai University, a global medalist in financial management, and an associate member of the Institute of Chartered Accountants of India. He has been with Axis Mutual Fund since 2012 and has been responsible for ideation, sourcing, and investment strategy for fixed income funds. Prior to this, he was with ICICI Prudential AMC as fund manager for about 4 years. He had also worked for Deutsche AMC and PwC. We are very happy to have you on panel, Devang, especially with your strong background. Thank you so much for being here.
My pleasure. Thank you. Thanks.
Last but not the least, we have Bhavesh Sanghvi, who's going to moderate today's session for all of us on our behalf. Bhavesh Sanghvi is a Chief Executive Officer of MK Wealth. He's an alumni of Columbia Business School and NMIMS. Bhavesh brings in nearly more than 3 years of decades now, of which almost 19 to 20 years are with financial services industry. Throughout his career, he has been known for building, leading, and motivating teams to excel in highly demanding and dynamic business environments. At MK, he puts good use of his entrepreneurial drive combined with business management skills to drive gains in revenue, market share, and profit performance. Thank you, Bhavesh, for moderating this. And with this introduction, I hand over the panel and the forum to you. Thank you so much.
Thanks, Parag. Those are kind words, and I hope that I'm driving you guys and the team pretty well.
Indeed.
So let's just open. So thank you so much to Rajni, Shailesh Bhai, Sri Datta, and Devang for taking the time off for MK. So why don't we just open this discussion by just having a quick view from each of you about what do you just think about the budget. Shailesh Bhai, being the senior
Sure.
most, you should go first.
Thank you. Thank you. So I'll say there are 5 constructs in this budget. One is that it takes us to a world of digitalization in every which way. 75 digital banks, last mile connectivity to rural, platforms, um, all sorts of digital connectivity. And the crowning glory is the announcement of the central bank digital currency and the recognition that NFTs are a virtual digital asset. This has caught the attention of the whole world. I've had the occasion to be in 2 international forums just after the budget. And in both those forums, this was what was resoundingly welcomed. People are virtually in awe that India has taken this leapfrogging decision to move into the digital world. The second construct of this budget is an intense crowding in for the first time of investment from the private sector, and not a word of skepticism or not a word of blame on the private sector. Instead, a desire to partner and collaborate. The PPP structure, which was broken, is being mended. Many outside the budget announcements, particularly those that deal with the speed with which government shall make payments to contractors. Now, all of these are the infrastructure which will enable investment in infrastructure to get catalyzed. So that's the second big thing. Third big thing is stable taxes, lesser litigation, no retrospective amendments, only clarifications, no big changes, just a directional continuity in the policy on budget making. Fourth, and perhaps most important, is it leaves room for being agile, flexible, resilient. So it does not make crazy, absolutely top end assumptions about growth or about how much resources will become available. Very modest. The arithmetic of this budget is resoundingly sound and capable of being accepted by all of us purely on common sense and based on near-term achievement. If we can have in the first 8 months growth of direct tax revenues by over 60%, I think that's a story that is emerging, that compliance has overtaken planning and that the digital aspect of our country's economy is delivering these extra resources automatically. And fifth, and perhaps the shining glory of this budget, is the accent on sustainability. Now, the connection and continuity between our commitments at COP26 and instantly being followed through by this budget on taking India to the high ground of everybody, all of us together dealing with sustainability. I see these 5 as the big constructs which underlie this extraordinary budget. I listened to the finance minister, completely riveted to the way she spoke. It was short, it was structured, it was brilliant. I must say that I was deeply impressed by what I saw coming up. So I'll stop there, Bhavesh.
Thank you. Thank you so much, Shailesh. Sridat, if you can go next.
Sure. So clearly, there were 2 or 3 key takeaways for us from the budget in terms of the direction. And you recollect last time also we spoke, effectively this was just a continuation of enhancing the productivity of every rupee spent that you earn as a government. And the seeds have been sown actually quite back. If you actually look back, if you have to become productive, first you have to put in place the systems. And I think the government has consistently in last 8 years, if you look at budget is just a point in time, but if you look at last 8 years since they have come in, what they're trying to do is to have everything organized, have everything digital, put in place the GST, have lower taxation system so that people have more incentive to actually pay up their taxes, which is reflecting in GST numbers, have Jandan accounts so that the leakages that were happening on the subsidy side can be reduced and the money goes to efficiently to the people who need it. So that I think for us was the most important factor, that there is no deviation from that goal. That has been the kind of journey for last 8 years. It continues. In fact, it is enhancing in terms of the simplification that is coming in more and more. So clearly for us, the first was the all the incremental focus on productivity. That was one. Second, if you convert it into numbers, and we are number people, so I would want to give a number. Is basically 3-4 years back, out of every 100 rupees, you are just spending 13 rupees on capex. That has moved in last 4 years after putting in place the systems for first 4 years. It has moved from 13-14 rupees to 19 rupees now. So clearly, within the constraints, so you are an emerging market, you are a 150 crore people country, you have resource challenges. How do you manage within those constraints, improve the productivity? I think that was the clear central message for us. That was one. Second, as Mr. Haribhakti also actually alluded to, the second message was again clear that okay, whatever we had to do on taxation front, all those things are largely done. So there is no tinkering around with anything, neither on direct side, not on indirect side. GST is anyways outside. So that was second. Third, for us was actually the conservatism. So clearly, it leaves a lot of room if you extend the current numbers, like again what Mr. Haribhakti actually alluded to. If you extend those numbers, you would be left with probably at least 1 to 2 lakh crore rupees of extra taxes next year to compensate for the headline numbers, which still adjusted for one-off looks lower because it's just 17% against the 35% that is reported in terms of numbers. So that was, I guess, third. And fourth, again, even in the budget itself, see, it's like earlier it used to be budget and you keep trying to find out one-offs. So you are actually taking care of all the one-offs. All extraordinary budgetary items have been brought in budget. So what you see is what you are getting now, exactly in terms of numbers. So I think these were 2 or 3 key kind of takeaways for us. Clearly, most important, whatever that 18-19 rupees you can use it productively on capital creation, asset creation, so that you can have job creation, you can have multiplier impact, and private sector invariably can pick up the baton at some point in time. So that I think that was the central message for us from the budget. Thanks.
Rajni, your thoughts?
So, as an economist, this year was kind of very difficult for us to take a call on how is the budget going to pan out. What should we expect from budget? I'll just elaborate what I mean. The macro backdrop was very complicated. We have certain K-shape of the economy that's yet to come back in terms of consumption numbers. At the same time, we have some post-pandemic realities to match up on in terms of, lay out the medium-term growth drivers, bring in the capex, bring in the infrastructure, crowd in the private investment. So consumption uncertainties still lay out on spend on consumption uncertainties, still lay out a backdrop for future private investment to come in. At the same time, the global rate cycle has started to turn up. While if the private sector investment has to come in, the budget had to make sure that the financial conditions for the domestic economy doesn't materially change. So, every which ways, it was a very, very difficult, tricky balancing track. Somehow this budget managed to deliver, which is amazing. And it is very, very difficult task on all sides, and this one managed to deliver. For me, a few things that kind of caught my attention was there is a sense of predictability and stability in the short run, as Mr. Haribhakti and Mr. Sridhar also mentioned. At the same time, it lays out the basic for next, they say 25 years, but I would say that, the whole thought process of budget going beyond a 1-year thought process is a big one. as an economy, you can never plan for year by year. You should have a long-term thought process. It kind of breaks into that pattern for budget as well, and also brings in a whole dimension of changing the economy towards digital climate targets. So, preparing for the future India or the aspirational India that we are all looking forward to. So that's also something that the budget managed to kind of deliver on. So overall, short-term, long-term, structural, immediate financing conditions, and also preparing for the future aspirational new generation India that we are looking forward to in next 25 years. It did an amazing balancing trick in that sense. So a lot needs to be done on ground in terms of how it's implemented, what are the outcomes versus outlay kind of discussion that one can potentially have. But as a starting point, as a thought, as a policy thought document, this is a very, very good start for post-pandemic recovery or post-pandemic India, the high growth India that we are looking forward to in the global context.
So thanks, Devang.
Yeah, so I echo, I think, the sentiments of the other three speakers. And if you ask me, I break the budget into two parts. One is the quality of the budget, okay, and the second element is the sources of financing. Now, being more into the fixed income side, sources of financing actually becomes very critical and important for markets, and it actually directs you what will be the direction of interest rates. So the quality of budget, I don't think so we have all any doubts in our mind. I think it has been very, very transparent budget. I think as highlighted by one of the panelists, that all the extraordinary, all the off-balance sheet items have been taken into account. So it's a very, very transparent and I would say growth-oriented focused budget. So from a perspective on numbers, we don't find any issues on the quality of the budget, the kind of growth they have taken into revenue. I think, in fact, they have been a bit conservative in the revenue on non-tax revenues, where they can have some more room. If you actually also look across at the quality, it is more non-inflationary. We generally, from a fixed income market perspective, what we focus across on is that whether the budget is channelizing the sources and the funds more towards the capex oriented budget, or it is more towards consumption. Somewhere down the line, I think government has continued with its growth and the capex oriented thought process, and hence if you ask me, our understanding is that the budget is a very, very good quality budget, growth oriented, conservative and transparent. So from a perspective on absolute numbers as well as quality, I think we give a thumbs up to the quality of the budget. I think the issue lies in the sources of financing, where if personally, if you ask me again, our view was that this year, the regulators, and we look at both government and RBI, both who are managing the entire show for last 2-3 years in this pandemic period. And before that also, India was going through some bad patch on account of liquidity and internal crisis on NBFCs and some kind of credit defaults. So the last 3 years, I think government and RBI have done a superb job. RBI managed the show till date, but now I think this year, any which ways, the heavy lifting had to be done by government, because we have started having an inflationary environment. Secondly, the most important element is that global central bankers have started turning hawkish. So it would be a difficult task for RBI to remain accommodative for long. So the heavy lifting had to be done for growth by government, and hence our assumption was that budget would be fiscally expansionary. But I think they could have worked more on the sources of financing, because I'm sure you looked at the headline numbers on gross borrowing and net borrowing and the market reaction to that, which is around 15-20 basis sell-off in bond deals, and which I think probably could have been done in a better manner, where they could have thought more on the sources of financing and they could have resolved some of the issues, which could have led to I would say thumbs up on both quality and sources. So I'm very happy with the quality of budget, but I'm slightly worried on the way they have done the calculation on sources.
Great. So, so thanks for the opening remarks. My own personal sense is that one of the things that, they have not done or they could have probably done was to also kickstart the demand side of the, economy. Right. But maybe, because of, inflationary concerns and bond yields and so on and so forth, or, the fact that today bulk of the inflation is actually imported. You look at raw material prices have gone up, transport costs have gone up. So maybe, the feeling is that, hopefully, this whole inflation will kind of settle down as COVID kind of keeps, waning away. And maybe that adjustment could happen, there basically. But they've not really done much on the demand side. I mean, if you look at the health of a lot of MSMEs and a lot of people, I'm sure the families would have got affected due to COVID. People may have lost their jobs, and I think things are obviously coming back, but they're going to take some time. But had they done something there, maybe by reducing taxes or reduce some indirect taxes to just stoke a little bit of demand, that would have been a good good thing to basically at least give in the hands of people. Sridhar, you mentioned that taxes have been rationalized, but I mean, I'm sure mostly on the retail side. I mean, you still have a large part of a population which is earning between, say, 10 to 20 lakhs, who's paying close to about 20-30% tax, right? So if they would have done some tinkering there and given some money in the hands of the people, that would have probably stoked some demand at least, essentially. To me, I think that was the only miss. And I think if you keep bringing taxes down, maybe rationalize it to say about 25 odd percent to the current 35, 40 odd percent with all the kind of surcharges, may also probably have, build a better compliance, like what you've seen with GST numbers and so on and so forth, right? So I think to my part, that was the only miss. Otherwise, I think it's been a good balancing act, as far as the budget goes.
So if I can come in, they have done two things, I guess, clearly. One is the credit enhancement scheme has been extended for SMEs, so that one thing has been done on SME side. In fact, there is, if you look at the numbers, there is no complete offtake of those numbers which are there. So which only tells you that probably there are not enough quality borrowers who are left to borrow that remaining limit. So that's one. As far as personal taxation is concerned, and that hurts all of us. But I guess it's a journey. The compliance on the business side has to go up significantly for them to actually reduce the taxation on the other side. You can't keep reducing the taxation because you're left with the 18, 19 rupees. So I think that's my two bit on one of your observations.
But let me come in, Bhavesh, on the very interesting way in which Devang positioned his comments, and particularly on the resource raising side. I want to say a few things. Number one, I'm not quite clear and sure, and the panel could clarify it, whoever is knowledgeable about it, on how this asset monetization program is going to play out and create a differential way to raise resources. In my accountant's mind, what I believe is that a 10 lakh crore investment in capital expenditure, if I add the central and the state governments, it creates a future asset which can be monetized as soon as the roads are completed and tolls are being collected and whatever else happens. So I feel that the asset monetization program, if it is juxtaposed with green bonds, with the fact that we will now have an encouragement to small savings, and the fact that there is disinvestment, which now looks credible. I think they have taken credit for the LIC IPO in March 22, and they are saying this 65,000 crores is over and above the LIC IPO. That's the clear signal that I'm reading from the numbers. If that is the case, then to my mind, and if we have the fortunate happenstance of oil prices moderating somewhat, because we have taken a solid commitment to EV vehicles, creating EV battery infrastructure, going solar, getting into renewables. If they can also turn the taps on increasing the productivity of underutilized nuclear assets, to my mind, we would be in a position to create a very interesting sourcing paradigm for the resources, Devang, to your very good point.
So I can chip in here. So thanks for the observations, but I completely agree. So Sailesh bhai, to be fair, I also said that they are conservative. So I completely agree on the non-tax revenue, the monetization plan which they had announced last year. They could have taken some bit of cash flows or some bit of monetization of assets there, and which could have helped them on reducing the market borrowing. Secondly, I think the telecom spectrum, I think they have not taken any kind of increased revenues there. I like generally our understanding is you will get some amount there, and probably it can be like, I mean, we are not talking about the last 3G auction which has happened, but in 2010. But we are talking about somewhere the rationalization of amount could have taken a 50,000 odd crores of revenue from telecom spectrum. Thirdly, I think the dependence, so they are somewhere down the line correlating an inverse relationship to rising rates and somewhere down the line the small savers, the financing which they can raise from small saving schemes. The logic is for them is because inflation can be higher, the savers might have a smaller pie, and hence probably the numbers there could be lesser. If you look at the last 5-7 years, I think somewhere down the line, the at least specifically last 5 years, small saving schemes have actually outperformed the numbers with their budget.
Absolutely.
And there, other than an average financing of 65% through dated borrowings and 35% through small saving schemes, they have taken a conservative stance of 70-30, where 70 they are taking through market borrowings, which is through dated securities, and 30% through small saving schemes. So I think there is ample room to readjust these sources of financing, and probably with a 6.4% headline number also, they could have tried to work along on all these issues and given us a lower market borrowing. I think they are the way of addressing this is that probably work with a conservative number, don't show an aggressive number, and try to probably beat the estimates, give a higher
Outperform.
Yes, outperform. So that's the focus of the way government runs. And but probably for the initial period, markets, and specifically I'm talking about more on fixed income here, might see this gross borrowing number as an issue. So there is ample room for them to increase the base as well as finance this in a much more structured way.
So I think, my first question, Devang, you more or less answered, but I will just put it up for the, benefit of the audience. So maybe Rajni, you can just start. So the question was that is the borrowing program of 14.5 lakh crores, is it a tough task? For the current year, the borrowings, program sail through GSAPs, and repos, and obviously you still had pretty easy money conditions, but is all of this changing very fast?
So I will just pick up from what we were discussing. The first question, is it a tough task? Definitely. And market was kind of working towards, even the 12 lakh crore last year was an upside, and then somehow market managed to absorb it. Do we have that domestic bond demand appetite enough to absorb this kind of a supply is a big question mark. And do remember, there's more state financing also due to come this year. But my sense is that there's some part of this accounting, all that we were discussing on the borrowing part, that is yet to come out. I mean, a big part could be from, if we have more foreign bond demand coming in. So that's a big one that's still left in the air and could potentially materialize in the second half. And as Devang was pointing out, there are some more spaces that's still not been counted in. So maybe when we close this year, we might have financing conditions that are not as tight as we saw immediately after the budget. That 25 to 12 to 15 basis point hikes should probably not happen, because the growth conditions don't really support that. We do need the domestic financial conditions to be very easy. Right. Given that the budget is not really, as you pointed out, focusing on demand conditions or where the tax breaks could be given and push immediate demand, there is a clear thought that growth is going to bring in that kind of an employment wage enhanced demand, which means it's going to run through the whole year. It doesn't happen in a month or two. The tax break could have easily given. But as an economy, of all the resources, what we are short of is capital. So all our balance sheet at the end of it is all about how do we manage the right amount of capital at the time when it can get maximum impact. So given that the policy thought process seems to be that there's not as much uncertainty on consumption outlook, and what needs to be supported is more in terms of investment, infrastructure. Let's front load infrastructure spend, let's front load capex, and then get the right conditions for the private sector to come in. At which point, the government balance sheet can then get onto the correction mode, which we've seen on the corporate balance sheet in last 2 years. So, to your exact question, is it a big ask? Yes, it's a big ask. I mean, Devang and I sit in a trade dealing room. Most of the traders would tell you there's no way we'll be able to absorb it. But RBI has been coming out with new tools. It does keep repeating that I have more tools to kind of manage it. Let's step back and think, as a central bank, what they need to do. Can they finance all of it? Not really. But what they need to do is roll it enough till the point that this whole 2.45 multiplier on the capital investment starts showing on their balance sheet. So that bit of management, we saw some actions just the day before budget was announced in terms of rolling some short-term borrowings again on. So yeah, so those kind of steps to just roll it off till this whole front-loaded public investment starts paying off the multiplier, and then the government balance sheet gets onto correction mode. So if you see even the headline fiscal number, which we were placed at anything between 5.9 to 6.4, and it kind of chose the upper end rather than on the lower end of the market. Not really worried too much on the rating front, not really worried too much on the consumption front, just managing its balance sheet till the multiplier starts showing on the gains, and then they can get onto the correction mode. So short term, yes, big ask, but my sense is there's more to come in the year as it goes by. So they're likely to kind of not really get to the market for this much of ask.
Devang, your thoughts?
So I probably Rajni has summed it quite well. If you ask me, just two bits. I think first of all, there is a possibility that you might see an increased non-tax revenue. Tax revenue, I think, depends also on that we don't see any kind of another wave of COVID, because you keep on getting new variants, and somewhere down the line, if we see any kind of lockdown, then a couple of months impacts the taxation, specifically some GST collections or corporate tax collections, and that is why we are not too bullish on, or they have not been very conservative on the tax revenue side. Secondly, I think crude can be a spoiler, okay, because if you look at lack of investments in commodities for almost 10 years, and specifically crude is shaping up right now. There are, as you rightly highlighted, there are some teething issues on supply constraints, but I think more it is a structural bull market for oil. So can we reach $100 on crude is very much a possibility. With those constraints, I think probably this year they also had this benefit on taxation on excise duties on petrol products, which probably can nullify the growth in tax revenue. So if I look at the numbers, I think tax revenue, not much space. Non-tax revenue, there is a decent amount of space, as well as the sources of financing, which I told you, the small savings schemes. But the near term, this number is not going to get immediately being absorbed by the market, because at 12 lakhs, the gap was 1.5 to 2 lakh crores, where probably markets were expecting RBI to step in and probably do some kind of similar acquisition program, which they did it in the last policy, April policy last year, the GSAP plan. With FPI investors not being there as of now, and there will be no announcement either on the capital gain tax or onto the inclusion on the indices, I think the gap widens from 1.5 to minimum 3 lakh crores. That kind of gap without an RBI intervention looks difficult, at least on the interest rate perspective. Not that I'm too bearish, because I would say 60-70% of the negatives are already in prices. When it comes to 10-year bond yield also at 7%, you are pricing in a 5.5 kind of a repo rate, terminal repo rate. You're also pricing in a significant, huge supply on government borrowing. But markets will remain iffy, because I think somewhere down the line, they should start talking about the global bond indices more, because that is a good source of financing. RBI, with its constraints on liquidity, will not be able to do much GSAP like they've managed to do last year, because it is a significant dichotomy for RBI that they are faced with a problem of inflation, somewhere down the line, a not so bad growth, and a hawkish wave of central bankers globally. So it is very difficult for them to go on add and support bond deals. So yes, in summary, there can be upside on the non-tax revenue, which probably will figure out in the second half of the year. And till then, we require some RBI intervention. If not, we can see some more bleeding in bond deals, another 20-25 basis.
But if I just go back to Devang, what you just said earlier, that you believe that they've been a little conservative in terms of their estimates, on the borrowing side. I mean, so do you think that that the bond yields have reacted in a much faster way? Basically, I mean, do you believe that the 695 that you're seeing could be actually 650, 660, 675, or could be 7 quarter?
So see, Bhavesh, actually, fixed income markets, and not only in India, and I'm sure all the panelists sitting here also, including you, would agree that we are the first to react. Its currency and rates are very forward-looking, and hence, once the rate hike cycle actually starts, you might not see any impact on bond yields. That's the way it is, except for the very short end of the curve, which gets funded on a daily basis. So long bonds, somewhere down the line, our view is that obviously they are reacting more to an inflationary environment. There, as I told you, they're probably pricing in a 5.5 kind of a terminal rate already, plus a huge supply pressure. But the problem is daily, weekly auctions. Okay, now weekly auctions won't go through without an intervention somewhere because the price actions are broken. Okay, you saw like 31st December, bond yields were at 640. We had touched 695. It's 55 basis in 40 odd days. Okay, now generally in a year in fixed income, even in a rising interest rate environment, we see interest rate volatility of 75 to 100 basis. This is traditionally over last 15-20 years. Okay, except for those QE and tapering years, if you pick up any year, generally 75-80 basis. 70% of that has happened in the first 30 days of the calendar year. So personally, if you ask me, I think intervention is required. What should be the ideal levels? Should have been 675. We should have not touched a 690-95. But because there is no clarity, and if government has given a number, though we all believe so, it is conservative, people will say that they would have applied their minds more and would have thought about that there are some kind of obstacles to the FPI inclusions. There could be some kind of obstacles to more disinvestment. So I think, yes, they might be surprised positively. Capital markets might be surprised positively the second half of the year. But for the first half, next 3 months, near term, you will continue to see volatility. And without an RBI intervention or an FPI news, bond yields can trend another 15-20 basis higher.
Okay, so we're talking about, in your mind, a scenario like a 705, 710. And I think broadly, if you look at the last 3 or 4 years, it's only from those levels, except for maybe a small spike to 730, 740. It's actually then just trended down.
Right. See, I think I always tell my investors, India rates over because we have still not marched towards a developed market economy rates. Okay, we are more because inflation in India continues to hover between 4 to 6. Developed markets is between 0 to 2. So what our understanding is that probably at 4-5% kind of an inflation, 5.5 kind of an inflation, India rates will always be between 6 to 8, the 10-year bond yields. Okay, the narrower band 6 quarter, probably to 7.5. We are at the upper end of now closer to 7%. I think probably a lot of sell-off has happened. 7 quarter plus, I think most of the negatives gets priced in. Okay, but bond deals in India probably will, you should sell long bonds at 6% and buy long bonds at 8%. That is how it has been for the last 10-15 years, because it will not significantly stay above those levels. Our understanding is because the borrowing program is mammoth, okay, probably we can see volatility in the near term, and the next 3 months you will see yields flying probably 710, 715. But on a structural basis, with 5.5 kind of an inflation, India growth, real terms at around 7.5 to 8%, we are slightly negative as compared to government projections, and we are not as bearish as RBI. So I think the truth lies somewhere in between. So at around 7.5% growth numbers and a 5.5 inflation, I think probably bond yields will sustain around 6.5 to 7 quarter for most, should sustain between that band.
So, just for the benefit of, everyone, over the last year and a half, we've been extremely bearish on the longer side of the curve. And we've kind of advised customers and actually stayed away from, duration. So that, in a way, has played out pretty well. And now I think, these are exciting times to get into bond markets. Plus minus 5-10 basis points won't matter really when, you're creating a 3-4-5 year portfolio, right? And
Sure.
so it's actually helped our customers. So Dr. Thomas and the team have been kind of bang on in terms of basically predicting a near-term scenario wherein we thought that we were not near fair value as far as bonds are concerned. So that's kind of played off pretty well. So my next question is, these assumptions on the taxes and the non-tax revenues, are they realistic? Is the tax buoyancy sustainable, or is it a phenomenon that we just seen over the last 3 months of this financial year, Shailesh bhai?
Bhavesh, what we saw in the first 8 months, the assumption for the balance of this year itself has been greatly pulled back. So if you take the average growth of the tax revenue enhancement, it is close to a little more than 1.5 times the GDP growth of 9%. Now, therefore, in my view, we are going to see a lesser deficit even in March 22, exactly as we saw in the previous year. From the budget estimates, the actuals actually were down by, I think it was 0.25%. I don't remember the exact number. But that performance is likely to be repeated March 22. My other conviction is that formalization is increasing dramatically. Nobody has any need for cash. Everything will be digital. Everything will be transparent. Everything will be reported. And therefore, there will be that natural enhancement through the formalization. I also believe that the quantum of effort that has gone into PSU disinvestment is so phenomenal that this 65,000 crore estimate for the next year will be easily met. That's my conviction. And some of the most potent instruments which are classified in our portfolios as debt is the asset monetization, bonds and InvITs and whatever else that will be issued. Those are so wildly popular that the minute an issue is announced, there is a clamor for them. And really what is happening is a rationing, because they're saying no less than 2 crore per ticket, and then they kind of bring it down to 1 crore, and that kind of stuff is very visible. So my own feeling, to answer your question directly, is that the assumptions, if anything, are conservative. So they have done two things. The inflation deflator that they have assumed is also very different from what they have always assumed in the past. So the difference between nominal growth and real growth, they have not discounted very largely. I don't know what kind of ideas are brewing in the minds of the ministry, but I would imagine they want to manage the macros, because even this morning, the economist tells us that in the long run, the savings glut will continue, despite the temporary blips that we have seen over the last 2 years. And so I think that will play out even in India.
So Sridhar, let me bring you in. There are two questions. One is, equity markets, the way I see it is, every person who's been wanting to adopt a wait and watch policy has failed miserably, right? We've had situations in which we've told customers that we don't understand, how will COVID behave? Please approach it systematically. That strategy has failed miserably, right? Because customers have unfortunately ended up buying, equity at a much higher price, right? Barring a few volatile sessions wherein the markets came down 10%, but again immediately went up 10%. Bulk of the FI selling has been absorbed by the domestic savers, basically, and that could also be because of maybe Robinhood investors, want of yields. Markets were cheap, post COVID, and so on and so forth. Now at these levels of 17,500 and 24, 25 multiple, we are obviously at a almost at the epitome of peak of the multiples that we've kind of enjoyed, from where we've seen markets actually going down. And now with oil prices going up, interest rates moving up, there are avenues for investors to save, right? So how do you see, at least over the shorter term, while I've not seen a single fund manager like you who's not bullish for the long term, right? But how do you see the shorter term playing out, given where oil prices are, and are there any sectors which have a negative impact as far as the this particular budget goes?
So, Bhavesh, you have to, when you look at the valuations and what has happened over the last 18 months, you have to clearly keep two or three contexts in mind. One is while the economy was hurt because of healthcare issue, what had also happened at the same time is that there was a disproportionate amount of fiscal support, and which was a direct support for consumption that was given globally more so than locally, but it was available. And to that extent, it has actually helped the aggregate demand from not falling, which would otherwise have fallen. So that is one context, which is why market has been really, really wide. Second, which you partly alluded to, is everything works on opportunity cost, and we have economists here. If your opportunity cost of holding the saving is so low, whether it is businesses or whether it is individuals, you would go searching for higher yield, and that's what has been happening, and that is leading to higher valuations in near term than where they should have been or where we want them to be in the context of normalized. So that's the second. Now coming to the next probably 6 months and next 3 years, I would divide it that way, because you also specifically asked me about near term. Because for next 3 years, again, I'm extremely constructive, and there is reason to be constructive. And in India, I guess, where your per capita is and the pace at which your economy is growing, at on an average in every 5-year bucket, there is always a reason to be bullish, unless until your valuation multiples, of course, are on really wrong side. But when you come to near term, of course, there are two or three things one has to keep in mind, and that's where for last almost 3-4 months we have a little more conservative in terms of our approach. We are kind of nudging the investors to look at 3 years now. The one-time disproportionate returns are behind. Your valuations are higher. Your earnings upgrade cycle to a significant degree has played out. Although there is no earnings downgrade cycle as of now, despite some significant pressure from raw material side, but your earnings upgrade cycle for the near term has kind of incrementally stalled or has moderated, and to that extent, that valuation which was, say, 3 months back about 23 times financial year 23 earnings has gradually actually come down to already 20 times 23. And earnings is, all of us know that it is a slave of earnings. Markets is slave of earnings, so markets keep rolling over. Is there change in the earnings view from near-term perspective? There is still no change in the earnings outlook. So you're going to get 35% earnings growth for financial year 22 and about 15 to 17% earnings growth for financial 23. As long as that earnings construct is intact, and we still feel that earnings construct is intact, and there are reasons to believe that why that construct is intact, your market will consolidate and actually time price correct, which is what we are observing for some time already. Probably it will happen for another 3 months, 6 months, and then probably will again roll over to financial year 24 and 25 earnings, because the earnings are not questioned. You will question the multiples in a meaningful manner when you start seeing earnings downgrade. We don't have as of now earnings downgrade. In fact, on the contrary, it's just the earnings cycle is changing the direction or the segment. You had last 18 months where the earnings upgrades were happening on the externally focused sectors. Now the earnings upgrades are going to happen on the domestically focused cyclical sectors, which is industrials, banks, cement, housing, which is already visible in terms of monthly number. Auto will be the next. So all those things is the place where the earnings upgrades are happening. So as long as those earnings upgrades are not in question, we are not calling out that, okay, even 20 times, although it is from a historical perspective little higher, we're not saying that market is going to correct 15%. Will market consolidate? It looks like market is going to consolidate for some more time. That is one. And second is, So there is so much of talk of inflation, okay, and I can be terribly wrong on this, but my take is in second half, most of the people will be more worried globally also on growth than inflation, because this inflation is created by pumping in $3-4 trillion in a short span of 15 months period. As that money goes out, do you have the same strength in the global economy to keep that aggregate demand at that level? Whereas the supplies will keep coming back, because supplies react to the incremental marginal change in prices of the products, and the marginal change in there is no marginal change. There is a significant change in the prices, which is visible in inflation. So my take is, on inflation side, people are probably far more worried than what they should be. Of course, we can be terribly wrong and it can go out of hand, but that's what our sense is. And
I would say, aapke muh mein ghee shakkar.
Let us hope so that that happens.
But
Otherwise, we have.
is that the reason why you're not seeing private capex? Because maybe that is the thing that is worrying most of the guys, saying that is this a very temporary phenomena, basically.
No, in fact, contrary, Bhavesh. I mean, like, and I was an infrastructure capital goods analyst when I started my career in last cycle. Uh, from 13 till 20, virtually both banking system and corporates were in a deleveraging mode. In fact, last 15 months, it's very perverse or very counterintuitive to think that this is happening in a period which is the toughest period, that virtually every sector has cleaned up the balance sheet, and most critically banking system. So you are on the right side of the cycle. So there is no emerging market which can get a economic cycle without banking system is in place. You have banking system in place, and you have corporate balance sheets in place. What will corporates do? See, like what you are alluding to, the opportunity cost was so low that retail investors and savers ended up going into equities. Same will happen to corporates. Indian corporates and promoters don't believe in giving a lot of dividend. They believe that they are better capital allocators. So OPEX cycle is already started. At some point in time, you'll start seeing the capex cycle also.
Capex.
In fact, we are seeing announcements in cement, chemical, pharma, metals, and so many sectors. I mean, virtually every day there is announcement. Of course, it's not as large as what we have seen in the last cycle, where people used to announce 5 million ton ka plan dalna hai, 10 million ton ka plan dalna hai. That is not happening. So I think that construct is there. Near-term headwinds are clearly there. But when you look at valuations also, you have to look at valuations don't react to interest rates alone. Valuations is a function of earnings growth and interest rates combined outcome. So if your earnings remain steady, or the strength remains there, even if interest rates increases, it won't actually impact the valuations beyond the point, beyond the consolidation phase, because even in last cycle between 4 to 7, you had so many interest rate increases. So our focus as equity investors is growth, and how much earnings growth is coming. Is that construct coming under question mark? As of now, the answer is clear no.
Would you say that the quality of earnings is also going to be under your scanner? Because it's going to be driven by sustainability, innovation, digitalization, all of these soft factors.
Yes, clearly. Also, actually, just a adjusted factor to that, while we talk about budgets and while we talk about the organized sector, all of us are actually ignoring how much of money is flowing into the startups. Last year, we effectively have more than $50 billion coming in on that side. That will translate into consumption for the listed space also at some point in time. I mean, those people will buy houses, those people will buy cars, and it is reflected in, clearly it reflects in micro markets like Bangalore and allied cities. So I think that will be another driver which people have to keep in mind.
So Rajni, where is the consumption, coming in from? Is there a lot to encourage both production and supply? Because the government is saying that, okay, we will take the onus of the capex, at least for the next year, hoping that private capex will essentially basically keep in. So is there enough done to create this whole consumption environment?
So basically, we have to just step back and look at how this whole cycle works together. On one side, you have consumption, on one side, you have investment, and they don't work independent of each other. As Shridath was also saying, there is a part of economy where there has been lots of investment coming from abroad, or even from domestic market, lots of investment onto e-commerce, digital, that space where we've seen this. and that is yet to flow onto the consumption side. So near term, there is an upside in consumption coming from that side. There is an upside in consumption coming from services sector normalization, which is yet to show up broadly for the economy. And there is an upside in consumption that's likely to show up given the fiscal impulse we've seen last year and which is likely to be continued this year. That is generally at the bottom of the pyramid. So there are three upsides to consumption right now built up into the system that will likely show up from now on to next 6 to 9 months. The expectation on the policy side is that by then the private investment crowd-in would have created further growth drivers. Now for the private sector, I mean, going back to what we were discussing before this, there are generally 3-4 conducive factors that turns around the private investment cycle. One is global growth. I mean, there have been very few instances where the global growth has been low and there is an economy which is on a very high domestic private cycle. That's unless it's forced by policy. So right now, that's something that is yet to normalize. It has another 6 to 9 months to run, and that's working in favor of the investment cycle. The second is on the financing condition, which remains ultra accommodative across the globe. Even though we are talking of monetary policy normalization, there's no thought in terms of tightening the financial conditions. There's only thought in terms of curbing the risk that this much of money in the system could create. So financing conditions remain supportive. Consumption upside comes in. Global consumption stays high. And then again, what Sridhar was mentioning, the balance sheet, the corporate balance sheet remains at the best possible scenario for the private sector capex to start pumping in. So all the conditions are aligned, except one. When I talk to my clients on the big corporate side, the short-term uncertainty in demand conditions play on their mind. They have to see concrete signs. They have to believe that, okay, we are well past the pandemic. Okay, there's still more consumption to come in, and hence my investment right now is going to gain that excess returns that it should. So that expectation of excess return versus and risk sentiment, that do I have another 6 months or 2 years of good consumption and hence I can go ahead and push up my investment. That's the one factor missing, which hopefully should kind of ease off in next 2 to 3 quarters. That's broadly seems to be the policy thought process as well. That's why you don't see so much of front loading on consumption and more front loading on investment. So next,
because what's going to happen is, you see, I don't think any corporate is going to think 2 or 3 months down the line that I want to start expanding. I want to do capex. Because by the time that capex kicks in, it's going to be at least another 2 or 3 or at least 3 quarters. By the time you set up the plant, by the time you monetize all those assets and stuff like that. So then you're talking about at least a year and a half through that particular journey. So are you guys, especially in the banking sector, seeing this excitement over, that signs of demands coming in with the hope that consumption is going to go up, or like you just said that corporates are still a little wary and it's still 2 or 3 quarters away?
So the working capital demand seems to be on an overdrive. Everybody wants more capital. Everybody wants to kind of start pushing up on what they really want to do over the next 2 years. On the longer term, on the 3 years horizon, there's still some bit of resistance at this point of time. I think not many corporates are yet convinced that the growth drivers are in place and it will likely show up. Fundamentals look aligned, the stars align, but that sentiment is still to turn around completely.
So Shailesh bhai and Sridhar both, I have a question for you. That is the crowding, of the private capex through this whole capex, outlay announcement going to work? I mean, it's more or less an extension of the discussion that we are having. But while the government is saying that okay, we are happy to take the burden for the next 1 or 2 years, will how do you see that essentially basically playing out, leading to private capex?
I think private capex will get crowded in. That's my frontline answer.
Okay.
And let me demonstrate that by actual examples. We have seen a massive commitment to green hydrogen, which I think there's going to be a competitive pressure actually to put money there. There's going to be a massive rush for semiconductor manufacturing. I'm sort of quite close to the developments there, and therefore I can say with first-hand knowledge that it is likely to be a massive spurt in semiconductor investment. So what you will not find the typical old world ways of capex being practiced by the corporations. You will see investments in these kind of areas. For example, there is a waste heat recovery program in cement, which is at a scale that I've never seen before. So these are the kind of investment that's going to happen. The other point I'd like to make is that the young generation is thinking of partnered ecosystems, capital light models, and looking at how do we leverage of what is already no point in reinventing the wheel. Let's leverage the partnership ecosystem. And I see far more collaboration happening. I also see a huge connect emerging between the big industry and the SME supply chain. So that's what's going to help possibly revive the SMEs, which have had the largest, borne the biggest brunt in COVID. So to my mind, all of this is going to encourage very different kind of capex from the type that we have been used to. You mentioned cement, and already we have very significant capacity of cement. We've got 250 million tons. We've got massive capacity in other commodities. We will need to wait for the supply to catch up with the demand to start seeing in traditional industry that capex. But in new age, I see capex happening at huge scale, and that's what's going to drive the next cycle.
Okay, so I'm extremely happy to learn that. I think there is clearly a divergent view between an actual banker who's on the ground, looking at, happy to lend money to, for sustainable, capital, apart from the working capital thing. But yeah, I mean, these are good divergent views.
Just to come on that, actually, when I read that, when I heard you actually crowding in, so like Rajni also mentioned, and I also alluded earlier, most of the factors are in place for the capex cycle to start. But the challenge with this kind of budget seems to be not more crowding in, but crowding out, because so financing can become a challenge if actually the private capex picks up faster than anticipated. My sense today is the way we are looking at numbers in BSE 500 in terms of capex, it is still slow. So probably it will take another 4 quarters or 6 quarters for really large commitments from corporates to come in, which is also reflecting in the large corporate group segment in the banking system in terms of credit, which is just actually turned around at zero, which was negative for last entire year. But if it really picks up faster than that, and if both these large borrowers, which is corporates and government, wants to borrow such amounts, then crowding in is so financing will become a bigger question than so crowding out can become a problem for you, because government will still borrow that number. But actually going back to Devang and actually Rajni's answers on that, and pardon me for getting into your area, but I don't believe they're going to borrow that kind of number, or they want to just actually have a very conservative, transparent budget, and then get the global bond get included in global bond indices and surprise, so that crowding in actually happens, because you need all those things for crowding in to happen. Otherwise,
correct.
You are you can actually face, that's the biggest negative that I worry about out of budget actually. If private capex gets upfronted and government also borrows that 11-12 lakh crore rupees of net borrowing, then who finances it actually?
Devang will be a worried man.
So, I think, two things really stand out if I look at over the last 2 or 3 years. One is, the fact that they brought the corporate taxes down to 25%. That, in a way, was to clearly encourage corporates to come and spend. Unfortunately, we got hit, the world got hit by COVID. I think this whole, I think India was clearly at a cusp of a massive re-rating, and then this COVID thing happened. Because like we said, that for the last 5 or 6 years, all the government has done is to put all the structural changes in place so that we move to the next leg, right? But yet they went and brought the corporate taxes down. They didn't tinker with it despite a tough COVID year, right? Because somewhere down the line, I think the belief is that, okay, you are better ROE generators, right? You generate the ROE, we are happy to support. The other thing that they've done in this budget is they've actually brought down the capex budgets of the public enterprises by 20%, right? So while they've raised their
The problem with my internet or Bhavesh's?
All of us were wondering. I think it's Bhavesh's.
Okay. But do you all not see that financing is going to happen through markets and through perhaps global markets rather than only through the banking system?
No, so I agree with Sridatta here that probably they will get or even I think Bhavesh spoke about it. They will get the FPI inclusion, but the problem is the timing. So I think in the near term, we can see some challenges, but I think on a medium term, I agree that they have to ensure they have to open up more sources.
There is no other place on earth where there is alpha.
I think that economic confidence is showing in all the policy making. I mean, some of the risks around consumption and all have not been acknowledged because they believe that we are the only place where there is an alpha. So capital across the globe has no other destination but to come to India.
Actually, it is true. I mean, when I sincerely look at it and look at the pointed way in which our corporates are making their capex, they're in IT, they're in digitalization, they are in conversion to solar, they are in putting up huge ways to reduce cost in future. Very efficient utilization of capital with quick return.
Sorry,
that's
what
I'm saying.
Blocked out.
No problem, Bhavesh. We continued the discussion that we began.
Great. Yeah, the other thing that they have done is they have clearly brought the capex of the public enterprises down. Maybe to sign and signal that okay, we will take the onus, because maybe we might be better capital allocators than what you guys have done in the past, right? So these are two significant signals that that I take from my perspective as far as this budget goes. So yeah, I think the verdict is pretty clear that private capex will take some time, and hopefully the government gets it right by doing all the spending that they promised, which basically they would. So the question, Sridath and Rajni, is that how does the promotion of local manufacturing and all these import substitution policies going to work out in the long run for the economy?
I will take it first. So yeah. I think it was import substitution maybe 2 years back when the whole global backdrop was more moving towards the import substitution mode of growth. COVID helped us get away from that. So it's more about promoting domestic manufacturing rather than an import substitution. And then thankfully that happened, because that would have been really, really suicidal as an economy, not for us, generally for global economy as well. And we've had there's a theory that goes back 2.5 centuries now, proving that how moving away from an import substitution model to a more inclusive global framework gives you more frontier. Not only gains in terms of capital productivity, it also gains in terms of other aspects of the business. But coming back, the whole focus is more in terms of pushing domestic manufacturing. And the challenge there is that for a good 25 years, manufacturing was left away from policy thought process. We as an economy, somehow, as we grew out of agrarian mode of economy, services started taking up. There was a short bout of PSUs driving the growth, and then services sector became much bigger than any other sector in the economy. Somehow in that whole process, manufacturing fell out of the major or core policy thought process. Still, income levels started coming in. Generally, most of these economic trends work over 1.5 decades at least to really start showing up. So that's something where we had to fail and then learn, and now to recalibrate ourselves. It was much needed. And in the whole pyramid, services again can grow only to a certain limit, and then manufacturing needs to be a very strong, vibrant sector of the economy to give that growth impetus to services. So to that extent, it's a big structural correction in policy thought process. Again, like it showed up over 2 decades, it's going to really work back into a positive stimulus only over at least a decade. It's not a process that can start showing up in next year or 2 years growth numbers. What it will get pushed by is some of these government targets, like we have a climate target now, and we've seen that push on the renewable sector or EV sustainability. So some of these sectors, now that those are new sectors, government has put around a target around them, and manufacturing has to pick up. These are ripe for good push on domestic manufacturing side. For the traditional manufacturing that we have, what we've lost is our competitiveness in terms of the whole thought process and on ROE. That's something that will take good 5 to 7 years, if not a decade, to really show up. So it's a good thrust. It's a policy rebalancing in a very good structural sense. But for it to show up, particularly in the traditional sectors, it's a long-term process. It won't happen in a hurry.
Okay.
I have a little different take on this. While a lot of these policies are clearly were needed, but on import substitution, typically, first of all, of course, no kind of hardly there is any. And Rajni, correct me if I'm wrong on this. There is hardly any emerging market which has actually come out of poverty significantly or gone to a very high per capita without exports being one of the sizable drivers. So. And where are we on that? Clearly on services side, particularly the IT, we are clearly almost leader there, and we are doing well. So that aspect was always there. What was missing was manufacturing, and manufacturing was largely missing because of partly also because of non-level playing field. Because lot of your competing countries were actually giving lot of, not only they had better infrastructure, so lesser friction cost, but they are also supporting on capital cost side. They are also supporting on subsidy sides and all that, which actually took them far ahead. And once you gain scale, then rest of the parameters fall in place. And so you were behind, and then you kept falling behind. Thankfully, now the two things are actually getting aligned again, and this is again a good thing that is happening. The cost structure of countries like China and other who are large exporters who compete with us on relatively mid to low end of export side, largely those countries, their cost structures are going up, their subsidies are going out of the system, and at the same time, so there is a window for you to first start with import substitution. Why import substitution or why import barriers are needed in specific regions or specific segments is basically you want to raise those import tariffs for some time, you give some level playing field, you gain scale in those industries, and then you actually get rid of those import barriers. And that's, I think, the first step that they're doing in certain sectors like APIs, chemicals, low-end chemicals, partly textile, your entire building material space. These are the spaces where they're already doing it. So I think that's the first stage. While it is retrograde, but it is necessary for you to actually create that ecosystem of that particular segment to gain a scale where without government support, it can actually stand and compete with the other countries. So that's one piece of it. Second, clearly these PLIs which are directed, and I have, at least personally, have always been believer that you need directed spending by governments. When government spends very broadly, it is always very inefficient. When actually they give directed benefits to certain segments and help ecosystems to get created, then private sectors in India have done wonders. And I think that's likely to happen over a period of time, not in all segments. And part of these PLI segments, out of these 8-9 areas, probably 2 or 3, we will have an ecosystem which will also lead to significant export benefits and import substitution, both that will come to us. In fact, there are certain numbers, and I'm just actually referring to Credit Suisse research reports here, that by financial year 25-26, you will start these PLI schemes adding anywhere between 0.25% to 75 bips to GDP on an annual basis, which is a significant number by any stretch of imagination. So that's how we are looking at actually import substitution and creation of manufacturing ecosystem. And I think whatever government is doing in a directed manner is good. It is good that they are reducing the government PSU spending. Good that they are reducing the central schemes and moving away from that, and actually putting that money rather in the hands of some of these private ecosystem creation. Not only that, in fact, there's one more point. What they're doing is they're all the industries where the ecosystem is already ready, they're reversing those benefits. So all the export benefits that were coming, it has already started in auto and all large OEMs. Like if you're Bajaj Auto, don't hold me against it, but why do you need basically support? I mean, 4% on every vehicle you sell. I mean, it can be 2%, it can be 1%. You don't need, you already have ecosystem. So that has already started, and it is being given to industries and segments and sub-segments where the ecosystem is still not in place. I think that's how broadly we are looking at this manufacturing piece of economy.
So I have two last questions before we actually open the house. So Devang, there was quite a lot of hue and cry on the credit risk funds. Now, do you think that scenario is kind of settled down? Do you think that's an opportunity for customers to start looking at, especially given where yields are actually? Is there an opportunity now in the credit risk funds?
Sure. So rightly said, I think probably almost 2 years back, this entire noise, or almost 3 years now, the credit risk funds have seen a lot of noise. But if you actually see in the last 12 months, credit funds have the best fixed income returns across all categories. You pick up the general returns are around 5% average, and credit funds have delivered around 7.5 or upwards of that. So I think Sridatta highlighted that fact also. I have not seen an environment where corporate balance sheets have significantly cleaned up and the banking mess has been significantly cleaned up. So today, if you ask me from an overall perspective, we do a top-down approach. And prior to heading rates and everything, I also used to take care on credit. So my understanding is 2-3 things. One is economy and credit cycle are positively correlated. Like rates and economy cycle is negatively correlated. The credit cycle goes positive hand in hand with the growth cycle. Growth cycle is showing an uptick. As I told you, we are somewhere in between. We are not as bearish as RBI nor as bullish as probably government. I think our thought is somewhere the growth lies in between. But with this kind of macro environment also, where every parameter is good enough, the top-down approach, credit funds and overall credit cycle looks quite attractive. Just to give you one more parameter, I think what we look at when analyzing credit funds, we look at 2 perspectives. One is the macro environment, which I said is positive. The second the second thing which we focus on is the spreads. The credit spreads, the risk what you take across should be attractive enough for investors to invest. I think AA oriented spreads today have compressed. They are not as lucrative as it was a year back, where 200, 225, 250 basis over AAA. That was just a very, very good spread for a AA, good corporates or AA segment. Today they are in the band of around 100 odd basis, where I would be neutral. But from a perspective on overall macro cycle, it still augurs well for credit funds, and I would advise clients to start looking at and allocating in well-diversified, lower duration credit funds at this point of time. Makes a lot of sense.
This whole thing on taxations on I think they called it virtual assets, or there's some name that came up.
Virtual digital assets.
Virtual digital assets, and I saw an interview of I think one of the investors which said that bitcoins and all of cryptos are finished, right? And the next day there was an article where all these guys like CoinDCX and all the other platforms saw the maximum jump of subscribers. So how people think and what actually happens are completely 2 different thought processes altogether. So coming to that, Shailesh bhai, this the surcharge on LTCG, has been capped at 15%. Can you please provide some clarity as to, investments in which all assets and what set of investors will benefit from this?
So it's going to be the large investors who had suffered a massive incremental tax on long-term capital gains because of the massive surcharge that was levied. They will be the biggest beneficiaries. Also, the intercorporate investors will have a big benefit from this. And therefore, I think they didn't want to tinker with the basic long-term capital gains tax rate, but this surcharge had outlived its impact. The other thing which we must read together with this is that all cesses on health and education, which many were claiming to be tax exempt, have been clarified to be not so. And therefore, there will be that pickup in revenues from the disallowance of the cesses. A related point is that the only way that we can encourage the startup ecosystem to continue along its path is if we do not levy large taxes on the pop that happens as a startup emerges as a investable proposition. But to just join the debate on the earlier issue, I'd say three things that I've seen very strongly. One is that investments in 4.0, manufacturing 4.0, are happening at scale in a very big way. The investments in increasing the productivity of assets rather than simply adding more assets, that is also increasing at a phenomenal rate. And people are going out and doing sophisticated financing in order to bring this into some balance to work to their benefit in terms of ROE enhancement, making sure that productivity rises and the company gets re-rated. So I'm seeing today a huge thrust of people wanting to have themselves re-rated because they want to be seen to be more productive and more efficient. And finally, on this crypto thing, it's important for everybody to note that India has the largest number of investors in what are now being described as virtual digital assets in the whole world. Actually, the quantum of Indian investors is equal to the investors in the rest of the world. Only in terms of numbers I'm talking, because India is, everything is numbers. And I think there has been a great misconception. Every time we hear the word crypto or we hear the word digital currency, we start thinking of the dark web. And we start thinking of all the wrong things that happen in that space. That need not be the case at all. I'll just give you one example, which is I'm very fond of quoting. The 300 Sumatran elephants, which would have perhaps died during COVID because there were no tourists to go there and provide revenues for their food to be given to them. So they issued NFTs, which were subscribed by global investors. And the proceeds from those NFTs went to feed these elephants for 2 years. And now a whole new dimension of NFTs has opened up. Can you have NFTs which give single view, which give limited period view, which give full possession with provenance? What is it that can be facilitated in a Web 3.0 no friction world? That is what we need to look at as the delivery from crypto and from this whole, frictionless, intermediary-less world that we are beginning to look at.
So, my last two questions, one to, Devang and one to Sridhar, before I ask Parag to take the questions and just open the floor. So from a 3-year perspective, I'm just being very specific. From a 3-year perspective, Sridhar, what do you think should be the allocation to equities in terms of large, mid, and small caps? One. Like, where's your preference? Is it 60, 30, 10, so on and so forth? And Devang, where should bond investors invest their money? In what duration? In what space? Is it credit? Is it short term? Is it medium term funds? I mean, there are so many funds from the industry, right? There are sometimes we get confused as advisors, but very specific takeaway for investors here on the call. What should be and where should be the allocation?
So I'll go first. I think clearly, given the liquidity environment in which we are operating, the valuation dispersion that was available in mid and small cap vis-a-vis large cap before the start of COVID, largely that has vanished. Are there opportunities? There are opportunities in each space, but on a broad basis, I think people should tilt towards at least 60% large cap, 30% probably 25-30% mid cap, and then rest small cap. So there is no. I'll also tell you why I'm giving that view. Is basically you are entering into an environment which is going to get more uncertain at a valuation which is more than fair, or at least fair. So you need to have earnings panning out as expected. So margin of error has clearly reduced as compared to past, more so in a mid and small cap, because your valuation discount vis-a-vis large and large cap has significantly reduced. In fact, they're at par almost now, all three categories. So it's better to be more conservative to start with and see how your economic cycle and earning cycle plays out, and how the global interest rate cycle plays out over next 6 months, and then probably reallocate incrementally towards higher risk if one has to do that from domestic economic cycle perspective for next 3 years. Yeah.
Okay. Devang?
Yeah. So for 100 rupee of debt allocation, I would say 35% in credit risk funds, diversified and low duration. Secondly, around 35% in target maturity funds 2027-28 at around YTM of around 6.5, 675. And thirdly, 30% currently to maintain an ultra short-term funds, because as we are just entering an uncertain and a reversal of rate hikes, I would want to keep some bit of cash for better reinvestments. So that's my allocation of funds.
Great, thank you. So Parag, if if there are specific questions which have been posted,
sure.
Can you just run them? Yeah, thank you.
Thank you. I think we have already exceeded our time, so I'll just kind of combine a couple of questions and take one or two questions so that it's widely covered. So there's a question which is coming from YouTube live stream. Will the capex push in the budget will help, and how far will the government succeed in managing the fiscal deficit? Anyone would like to take it?
So
Well,
I can take the fiscal deficit part if you want. The fiscal deficit, I think the government will be, as the consensus is that probably we might see a better revenue stream. So I don't see any problems in managing the fiscal deficit. So no concerns there on the fiscal deficit.
Absolutely endorse Devang's view on fiscal deficit. And in terms of capex, it will be fabulous. See, we need to improve the competitiveness of India. If we want to be an export-oriented nation, whether for services or for manufacturing or for agriculture, we need the right roads, we need the right connectivity of ICT, we need the right logistics, the linking of rivers, the ropeways. Reduce the biggest cost which makes India uncompetitive is our inability to reach goods from one place to another at the lowest cost in the world. We are off there in a big way. And that's what Gati Shakti investment of 2 lakh crores is going to do.
And I'll add my 2 bits here. What has also been seen in this budget is now including state in their whole capex plan, because they do come at the front end. So that's a big change. Including state in your capex plan makes it much more effective and much more faster as well. So the delivery will be much faster.
Fully agree.
Very true. The next question is, can you throw some light on central bank digital currency and its impact?
So I'll go there because that's an area of I've spent the last whole month studying this area just accidentally. What this will do is it will enhance the trust in the medium of exchange. So what does a central bank digital currency do? It becomes a part substitute of the paper fiat money. And it will also be a ability for people to transfer between paper money and digital money. The cost of using cash was estimated by Reserve Bank of India some time ago at over 7%, because of all the risks and all the transfers and all the storage in various places and distribution, dissemination, all of that was extremely costly. A digital currency will cut out the cost of the medium of exchange dramatically. It will also make traceability of transactions, which is the basics of the rise in tax revenues in India, a very big, it gives it a big pop. Because almost everything you do today, it's so inconvenient to use cash. And it will become so much more convenient to use digital currency. We have a UPI infrastructure. So once the CBDC comes in, we will have much faster formalization, much better traceability of transactions. So what is my expense has to be somebody else's income, right? And ultimately, we are moving towards an era in taxation where taxes will not have to be filed and not returned. They will be determined because there is enough information available, which will enable the tax gatherer to actually send you a notice, and you just pay it, and that's done. There's no more cut. And the other thing that I'm seeing is that this will facilitate instantaneous transfer of money between one part of the country and the other. And as more adaptation happens globally, we will see an instant movement of money digitally between one part of the world and the other, which is a huge, huge benefit to the bottom of the pyramid. And therefore, the central bank digital currency is something that we must welcome, but we must make sure that it gets adopted on a global basis, because that's going to deliver the biggest, greatest value.
So just to add, in terms of crypto being taxed now, so are we to say that, crypto, as per government, is now a legal tender?
No, not at all. I mean, this is an absurd assertion. All that is being said is that if you have a virtual digital asset, like the NFT, which I talked about some time ago. So the entire Bollywood has lined up to get their NFTs done. The entire sports world has lined up to get NFTs done. And there's going to be a massive application of NFTs in many innovative ways in the sustainability space, in the digital space. For example, yesterday, I traveled into a metaverse and actually experimented with filling my digital wallet with NFTs, which represented the greatest innovators of the world today. So one could actually pick up these and put them into your wallet, and you could use them as your possession for the rest of your life, bring them up whenever you want, take a look at it, many functionalities. Now, if you have such an asset and you find a way to monetize it and take a profit from it, then what the government is saying, make us a partner, share with us 30% of the profit, without our being obligated to share any of the losses, and make sure that your transaction is traceable, because there is a 1% tax collected at source with every acquisition of an NFT. So that's what it is.
Great. Thanks. So Devang, there is a question for you. Any expected response from RBI on the budget?
So I think probably this is non-inflationary. So, and RBI might just want to react to hiking the bit of reverse repo and probably I'll assign a 50-50 probability to move to neutral stance, because somewhere down the line, the thought process is that the accommodation is no longer required. So they can keep the markets ready, and they would want to communicate rather than doing any kind of rate hikes. So reverse repo rate hike and bit of moving to neutral stance, a 50% probability to move to neutral stance is what I believe so. Reverse repo rate hike will not have any impact because the entire market is now getting financed and funded at 4%. So it is actually there is no much of a worry on account of that. I don't see any kind of repo hikes in this policy. I think probably April to June is where they will, if crude continues to behave the way it is, they will probably look at some bit of gradual rate increases.
Great. Thanks. Thanks, Devang. Any view on gold as both debt and equity as an asset class are in consolidation phase, and global interest rates and inflation along with geopolitical tension is on the rise? Will it be wise to increase weight in yellow metal at the current juncture is a question. Anyone can take.
I have no clue.
So, I'm no expert on gold, but in fact, gold is a good indicator that, I mean, I'm just digressing a little bit. Gold is a good indicator why even I feel that the inflation is not going to go up. So there is no reason to buy gold. And if inflation were what it is actually, and if market was to believe that it is going to be 7%, gold would have actually done significantly better than where it is. But I believe that given the way fiat currency is being printed, given the lot of chaos that is happening, and partly I don't agree with Mr. Shailesh with on the cryptocurrency side, it is better to have something which is a effectively universal currency. So it's a good hedge against your own government's fiat currency, global currencies, and particularly fiat currency. So one should have it as an insurance rather than investing it as an asset class. So I typically believe that everybody should have 5 to 10%, 15%, depending on how conservative a particular guy is, that as a insurance rather than anything else. Then
I agree with that completely. It's a store of value. It's not a medium of exchange.
Rajni, any view from your side on this?
So again, I mean, I'm not a trader and won't have trading views per se, but my sense cross asset is that gold is the asset for flight to safety. Given that we are moving away from a volatile macro environment onto a more predictable and upward looking macro environment in next year, and hopefully longer than that, then the kind of gain one would expect in other markets and on other assets like equity, for example, is not what we would likely see on gold side. But that's purely a cross asset view rather than any particular view on gold or what values.
Okay, I think that's it. I think we have covered all the questions. With deep gratitude to each of the panelists, Shailesh Bhai, Devang, Rajni, Sridhar, and all customers and clients who managed to. I know we are about 4-5 days late on our budget analysis, but we thought let everybody do it, and we add 2 bits from our side. This session will also be available on YouTube. I will send it to all the clients as well. Thanks, Bhavesh, for a great moderation, and thank you all of you for joining. Thank you very much. Have a peaceful and safe weekend.
You too, everybody.
Thanks,
wonderful.
Thank you, everyone. Thank you so much.
Be safe.